Today, vague Bank of Japan tweaks yield curve control and... Hello again, it's Martin North from Digital Finance Analytics, where I've noticed posts covering finance and property news. Well, while global financial markets are tightly coupled, the Bank of Japan has typically had a limited bearing on the markets generally. But on an otherwise quiet Friday afternoon, one sentence in its latest policy decision sent ripples through equity, foreign exchange, and bond markets. And the fact that the Bank of Japan's statement came towards the end of its typical release window had traders on even higher alert. Now it's early days, but there's a potential for some major asset price moves to occur in the days ahead. The Bank of Japan on Friday loosened its yield curve control, its YCC policy. That's been a pillar of the central bank's efforts to limit borrowing costs and to stimulate the economy. The vaguely worded move sent a shudder through asset classes on Friday in Asia, even after rumours of such a move had rattled trading desks the prior afternoon in New York. Yields on 10-year Japanese government bonds jumped to their highest since 2014, while the yen seesawed between gains and losses, as investors speculated whether this tweak was a precursor to more drastic changes for Japan's ultra-easy monetary policy. This volatility highlighted the challenge facing the Bank of Japan Governor Kuze Ude, who took over earlier this year and who is tasked with phasing out the policy without triggering market turmoil. The stakes are very high indeed, with significant implications for global fund flows. Japanese investors are the biggest foreign holders of US government debt and own sizable amounts of European bonds. Now this matters because the Bank of Japan's ultra-low interest rate policy was one of the few remaining forces anchoring long-term bond rates. So long as the trillions of Japanese capital could only earn 0.5% on 10-year bonds, they were forced to venture to bond markets such as the United States and Australia for yield enhancement. If the Bank of Japan is prepared to loosen that peg, the implication is for other long-term bond rates to rise because Japanese demand for foreign bonds will reduce by the higher rate. So let's look at how the Bank of Japan's yield curve policy worked and how it's now been changed. Bond yields, of course, are expressed as annual percentage terms, and they show the rate of return you expect to get on a particular fixed income security. The gap between yields on different maturity instruments is known as a yield curve. And most of the time, investors demand higher returns for locking away their money for longer periods, with the greater uncertainty that brings. Hence, yield curves usually slope upwards. But yield curve control was introduced in 2016 after years of heavy bond buying under quantitative easing. The Bank of Japan wanted to keep short to medium-term rates low while allowing long-term rates to go higher. The goal was to encourage consumers to spend and to head off the risk of deflation without depressing returns for financial institutions, including life insurers. The target for the 10-year government bond yield was set around 0%, while short-term rates were set at minus 0.1%. Now, initially, there was no clear trading band around that, although over time it was understood that the central bank was allowing a band of around 0.1 percentage points in either direction. In 2018, the Bank of Japan widened the band, saying the 10-year yield would be allowed to move about twice as much as the initial limit. While market players concluded the new limit was 0.2 percentage points, the Bank of Japan clarified that the band was 0.25 percentage points in both directions back in 2021. And then, last December, the Bank of Japan tweaked it further to allow long-term yields to move 0.5% in both directions. So today, rather than announcing a new band, the Bank of Japan has said it will control 10-year yields flexibly. It will allow them to rise above the 0.5% level that is now a reference rate, while nimbly using bond purchases to guide yields. And the central bank will also offer on a daily basis to buy 10-year Japan government bonds at 1%, effectively lifting the yield cap to that level from 0.5%. And by keeping the 0.5% target in place, the Bank of Japan appears to be trying to rein in speculation of further policy tightening ahead. The Bank of Japan's monetary stimulus program, spearheaded by the previous central bank governor, has turned the bank into the largest owner of stocks and government bonds in Japan. Yet, it has failed to boost the world's third largest economy in a sustainable way. It's also undermined the value of the yen, pushing up imported costs and consumer prices. Furthermore, there have been signs that Japan's debt market, the world's second largest, was no longer functioning as it should. With more than half of all government bonds now the property of the central bank, trading in what should be an easily available asset thinned. So the Bank of Japan has said these tweaks to the YCC band are aimed at improving the functioning of the market, a position it reiterated again on Friday in its presentation. So, is this the end of Japan's easy monetary era? Well, the Bank of Japan will say likely it's not. Kuroda announced the previous tweak in December and denied it was a precursor to tighter policy, saying the move was aimed at enhancing the sustainability of its monetary easing. But many economists interpreted the move as laying the preliminary groundwork for exiting a decade of extraordinary stimulus policy. This is important because the Bank of Japan is the world's last major anchor of rock-bottom interest rates, and Japanese investors have spent more than $3 trillion offshore in search of higher yields. And economists warn that even a small shift to policy normalization may prompt Japanese cash to flood out of global capital markets and go back home. So while the yen seesawed on Friday, speculation of a more significant shift, such as the abandonment of YCC, is likely to bolster the yen and deal a blow to bond markets where Japanese investors have significant holdings. And this could include bonds in Australia, where benchmark yields jumped as much as 20 basis points on Friday, France, and in the US. The Bank of Japan wants to avoid premature speculation of rate hikes, and it's still uncertain about how successful UDEDA will be in relaxing its control over yields without causing huge market volatility. Friday's tweak, which was reported in advance by the Nikkei, could also raise questions about his credibility. In fact, the Bank of Japan's wording also risks undermining the clarity of its policy communications. The yen's volatility following the announcement may be a reflection of that too. But this is a clear sign that the Bank of Japan will have to respond to the inflationary threat and accept it can no longer suppress its bond market and its exchange rate. That it has chosen to do so, just as its peers are in the final stages of their battles, adds to the intrigue. So this is definitely one to watch, because it's clear that the Japanese central bank has been out of kilter with other players around the world. And if indeed they do begin to try and normalize, that could have significant and profound global implications for capital markets, inflation, and the cost of money. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.